Should you invest or pay off your mortgage early? The decision between paying off your mortgage early or investing, it is a tough one. The choice depends on how much money you have, your tolerance for risk, and the length of time you have until retirement. Paying off your mortgage early is a great idea if you are not willing to take on any more risk than you already are by owning a home that is now worth less than what you wanted. Alternatively, investing the money in the stock market may provide more attractive returns with less risk than simply keeping it in cash instruments like bonds. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. There are two main factors that need to be considered before making a decision. The first factor is the interest rate on the mortgage, and the second is how much risk you are willing to take with your investing portfolio. If you have a higher interest rate on your mortgage, then you would likely want to pay it off as soon as possible so that you can save yourself from paying more money in interest over time. If the interest rate on your mortgage is low, or if you get a lower mortgage rate by refinancing, then it might make sense to invest in stocks instead because of the potential for greater returns. You undoubtedly fantasize of the day when you won't have to worry about making a mortgage payment. Being debt-free is a noble goal, but it may not be the best financial decision. It's cheap to hold debt, especially now that mortgage rates are so low. This leaves you with the option of increasing your money through other investments. Let's look at an illustration. Assume you had a $200,000 30-year mortgage with a 4.5% fixed rate. According to our mortgage calculator, your monthly payments would be $1,013, not including taxes and insurance, and you'd pay a total of $164,813 in interest over the life of the loan. Let's imagine you have an extra $300 per month to contribute toward your mortgage. You've saved $67,816 in interest in 11 years and 1 month from your payback time. You may, on the other hand, invest that $300 each month in an index fund that tracks the S&P 500 index. Since its creation in 1926, the S&P 500 has returned an average of 10% to 11% annually. We might, however, assume an average yearly return of 8% on your investment if you wish to be extra cautious. You'd have $160,780 at the end of 19 years, about the time it would take to pay off your mortgage early. That's more than double the amount of money you may save on interest. In reality, you'd have around $105,487 left on your mortgage after that period. You could utilize your investment funds to pay off your mortgage early and still have $55,293 left over if you choose to do so. The benefits of paying off your mortgage early versus investing. It's usually better to invest your money rather than use it to pay off your mortgage faster from a financial standpoint. Of course, life is more than just a series of statistics. There are a variety of reasons why you would want to pay off your mortgage sooner rather than later. Early interest savings. One of the biggest advantages of paying off your mortgage early is that you save money on interest. This is one of the most significant advantages of paying off your debt early. Thousands or tens of thousands of dollars in interest payments could be saved. Those interest savings are a guaranteed return on your investment when you pay off your mortgage early. Peace of mind. If you don't enjoy the concept of being in debt all of the time, paying off your mortgage early could help. If you got a financial emergency, owning a paid-off home means you won't have to worry about missing mortgage payments and possibly losing your home to foreclosure. Property taxes will continue to be your obligation as long as you own the house, but they will be a lot lesser financial burden. Build equity. Paying down your mortgage faster means you'll have greater equity in your property sooner. This may help you qualify for refinancing, which might save you even more money over time. You might be able to use your equity to get a home equity loan or a home equity line of credit (HELOC), which you can use to make upgrades to your home or pay off other higher interest debt. Disadvantages of paying off your mortgage early. Any money you save by paying off your mortgage faster is money you can't put toward other financial goals. You may be sacrificing your retirement savings, emergency fund, or other higher return investments to pay off your mortgage early. Wealth is tied up. Property is an illiquid asset, which means it can't be quickly or readily converted to cash. If you got a financial emergency or wanted to take advantage of an investment opportunity, you'd have to not only sell your home, but also wait until a buyer was found and the deal was completed. Loss of tax benefits. If you pay down your mortgage instead of maxing out your tax-advantaged retirement accounts, you will forfeit certain tax benefits. Furthermore, if you generally itemize, you may miss out on tax deductions for mortgage interest. Investing your extra money has its advantages: higher returns. The greatest advantage of investing your money, rather than utilizing it to pay down your mortgage faster, is the return on investment. For many years, average stock market returns have outperformed mortgage rates, which means you can profit handsomely from the difference. Unlike a home, which binds up your money, putting your money in stocks, bonds, and other market investments allows you to sell and access your money whenever you need it. Company match. If you opt to put your extra money into a retirement account and your employer matches it, it's free money that will grow over time thanks to compound interest. You'd also be investing pre-tax funds, which would make it easier to make larger donations. Cons of investing your extra cash: higher risk. Year over year, the stock market is more volatile than the housing market, so make sure your investing timeframe is long enough to weather the ups and downs. You must also ensure that your investment strategy corresponds to your risk tolerance and that you are mentally prepared to take some losses. Increased debt. If you don't like the concept of being in debt, investing your money might not be the ideal alternative. You don't own your home until your mortgage is paid off, the bank does. And there's always the possibility of losing your home if you can't keep up with the payments. Refinance and invest for the best of both worlds. If you're still undecided about which choice is best for you, you might not have to pick between paying off your mortgage early and investing. Instead, you might take a two-pronged strategy to debt reduction and wealth accumulation. Mortgage rates are at an all-time low, making it an excellent time to refinance. If you took out your mortgage or last refinanced several years ago, you may be able to save a significant amount of money by refinancing to a lower interest rate and/or shortening the duration of your mortgage term. This is true whether you opt to pay down the debt more quickly or not. When doing the math, make sure to account for closing costs. You can also invest now that you have your newfound mortgage savings. This allows you to spend less on your mortgage overall while still benefiting from the stock market's higher returns. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.